I'm about to show you 5 funds that could turn your small monthly investments into serious wealth. But 3 of them have a hidden flaw that most beginners completely miss. Stick around, because by the end of this video, you'll know exactly which one I'm putting my own money into for 2026 and why the safest choice might actually be costing you thousands.
You know what? Investing used to feel completely impossible to me. I'd picture Warren Buffett in some New York high-rise, analyzing which startup would become the next tech giant. But here's the thing. I was just a teacher with a small paycheck and 0 formal training. Picking the right tech company, that felt way out of my league. I had no idea how to evaluate a founder's background or decode 100 pages of financial statements, and I definitely didn't have decades of experience to fall back on. That's when I discovered Tech ETFs, and honestly, they changed everything for me. What are Tech ETFs? Instead of trying to guess which company becomes the next Microsoft, you can buy a fund that includes tech companies already vetted by experts around the world. But here's what you need to know. Not all tech ETFs are created equal. Some are way too expensive, others are too concentrated in just a few stocks, and some look like tech funds but aren't really pure tech plays. So today, I'm breaking down the ones that genuinely stand out to me. If I were starting fresh in 2026, these are the exact funds I'd consider buying. What is a tech ETF? First, let's cover the basics. A tech ETF, or exchange-traded fund, is basically a basket of technology companies wrapped into a single investment. They're sometimes called growth funds because these aren't just any tech companies. They're companies projected to grow fast. Here's how it works. Imagine a fund manager at a company like Invesco building a tech ETF. They study which companies have shown strong growth and choose names like ASML, Broadcom, or Adobe. Then anyone, even a middle school math teacher in Southern California, can open an app like Fidelity or Schwab and buy shares of that ETF. As those companies grow, your investment grows right along with them. These funds work especially well if you have over 20 years to invest and you're comfortable with volatility. Tech historically grows faster than safer investments like S&P 500 funds, but the ride gets way bumpier in the short term. All right, let's dive into 5 ETFs worth considering. First up, QQQ. This one's the veteran. Invesco created it back in 1999, right when internet companies were absolutely exploding. Startups were appearing overnight. GeoCities helped people build web pages. Cosmo promised 1-hour delivery for snacks and magazines. The internet was reshaping everything. There was this company called The Globe, basically the precursor to MySpace, founded by 2 Cornell students. Its stock jumped almost 600% on the first trading day. That's one of the biggest first-day pops in history. Invesco created QQQ in that climate to track these fast-growing tech companies while spreading risk across multiple stocks instead of just one. Then, the dot-com bubble burst a year later. Companies crashed and disappeared. The Globe stock collapsed and never recovered. It became the poster child of the crash. Even QQQ took a massive hit. But Warren Buffett said it best. Only when the tide goes out do you discover who's been swimming naked. The bubble exposed companies that weren't built to last. The survivors became the foundation of modern investing. QQQ dropped the losers, picked up the new winners, and recovered over time. Today, it's packed with companies like Apple, Amazon, and Alphabet leading the charge. I personally invest in QQQ because it has extremely high trading volume, which makes it perfect for selling covered calls. That's an income strategy where you own shares and agree to sell them at a certain price in exchange for collecting a payment up front, kind of like collecting rent on property you own. For example, if QQQ trades at $450 and you own 100 shares, you could sell a covered call at $470 and collect a $300 premium immediately. If QQQ never hits $470 by expiration, you keep the shares and the $300. If it does hit $470, your shares get sold at that price and you still keep the premium. QQQ is perfect if you want long-term exposure to large, established tech companies, decades of proven history, and flexibility to use income strategies. Next, QQQM. This is the budget-friendly version of QQQ. Invesco launched it in 2020 because investors wanted a tech ETF with a lower share price and lower ongoing costs. The biggest difference? Affordability. Every ETF has an expense ratio. That's the annual percentage of your investment that goes to fund managers. QQQ charges 0.2%, so if you invest $100,000, you pay $200 in fees per year. QQQM charges 0.15%. On that same $100,000, you only pay $150.
That $50 difference might seem small now, but imagine having a $500,000 portfolio. You'd pay $1,000 yearly with QQQ versus $750 with QQQM. Over decades, especially when reinvesting, those savings compound significantly. I personally invest in QQQM because of the low expense ratio and lower cost per share. The lower share price makes it easier to buy consistently, especially when starting with smaller amounts. It removes that mental barrier of needing to save up just to afford one share, which helps you stick to monthly investing without skipping contributions. QQQM is basically tech investing built for everyday people. Someone with modest means and a long time horizon can buy in easily.
ETF number 3, VGT. Next up, VGT. Vanguard created this in January 2004, not long after the dot-com bubble when valuations had reset and created opportunities for long-term growth. Here's what makes VGT different. The first two ETFs we covered, QQQ and QQQM, track the NASDAQ 100, which is basically a list of the 100 largest non-financial companies on the NASDAQ exchange. Think of an index like a scoreboard, showing how a specific group of companies performs. ETFs try to match that scoreboard's performance. VGT works the same way, but tracks a much broader index, the entire U.S. information technology sector. It casts a wider net, capturing up-and-coming companies that might eventually become industry leaders. It also has an even lower expense ratio than QQQ and QQQM, at just 0.09%. Since launch, VGT has grown nearly 1,500%. If you'd invested $100 monthly since 2004, you'd have put in around $25,000. That investment would be worth roughly $120,000 today. Now here's the downside: volatility. In 2022, when the S&P 500 fell 18%, VGT dropped a massive 30%. Imagine watching a $500,000 investment slide to $350,000 over a few months. That's the emotional reality of tech investing. If you know you'll panic sell during dips, you might be better suited for a broad fund like the S&P 500 or a total stock market index. They still move a lot, but not as aggressively. But if you can stomach that volatility, the upside might be totally worth it. Tech ETFs like VGT tend to outperform safer ETFs over long periods, meaning your money has potential to grow much faster. For me personally, the risk is worth it. If I were in my 20s or 30s looking for long-term growth and wasn't already in another growth fund, I'd absolutely invest in VGT. ETF number 4, VUG. When Vanguard launched VGT, they also launched VUG on the exact same day. VUG is different because instead of tracking just the technology sector, it tracks the crisp U.S. Large Cap Growth Index. This includes companies with fast-growing earnings, strong sales momentum, and expanding market share, whether they're in tech or not. It holds tech giants like Apple, Nvidia, and Adobe, but also non-tech growth companies like Home Depot, Eli Lilly, and Visa. VUG is basically a broader version of a tech ETF. It still holds major tech names, but diversifies into retail, healthcare, industrials, and financial services that meet growth criteria. This makes VUG great for investors who want tech-driven growth while diversifying into non-tech companies scaling quickly. VUG also dipped in 2022 because of heavy tech exposure, but it's grown roughly 900% since launch. That's lower than VGT because it spreads across more sectors, but higher than broad market funds like the S&P 500. One of its best features? An extremely low expense ratio of just 0.04%. It's a strong option if you want long-term growth with a smoother ride than pure tech. Finally, let's look at the wild card that's been gaining attention, KEMQ. This one's completely different from everything we've covered. It's not even focused on the United States. KEMQ is an emerging markets tech ETF. It invests in companies growing quickly in places like China, Taiwan, India, and Brazil. These countries are reaching points where millions of people are getting access to online payments, cloud services, e-commerce, and digital infrastructure for the first time. When that happens, entire industries can scale almost overnight. That's the opportunity KEMQ targets. Instead of established American tech giants, it focuses on fast-growing companies in economies just beginning their major tech adoption wave. KEMQ is fairly new, launched in 2017 by CraneShares, which specializes in emerging market and China-focused ETFs. Think of it as the up-and-comer rather than something like QQQ with decades of history and proven recovery from downturns. KEMQ has a relatively high expense ratio of 0.5%, and since launch, its overall return is just under 2%. That's not impressive compared to funds like VGT or QQQ. But the share price sits around $25, and if emerging market tech enters a serious growth phase, early investors could see great returns. Still, there's no guarantee. In my opinion, this is the highest risk ETF we've looked at. Limited historical performance, high fees, and exposure to economies where regulations, currencies, and political conditions shift quickly.
This could either hold the fund back or fuel growth. You don't know which. I know some of you asked about this ETF, but I wouldn't invest in it personally. Really though, it's up to you and what you're comfortable with. My choice for 2026. So, as promised, here's which ETF I'd invest in for 2026. The winner by far, QQQM. The biggest reason I lean toward QQQM is because I'm 38 and still investing with a long horizon. I want something I can hold for at least 20 years, something with a long track record, predictable behavior, and strong long-term growth. I'm also bullish on the companies in the NASDAQ 100. QQQM checks all those boxes. Historically, it's outperformed many broader funds blending tech with slower growth sectors. It's affordable, efficient, and has decades of data behind its strategy, even though the fund itself launched in 2020. If you want my ETF comparison charts and step-by-step guide on investing as a complete beginner, download my money cheat sheet. Links in the description below. I hope this helps, and I'll see you in the next video.